Hello. We're still looking at in this question at note number 3 in depreciation, and the different workings that you mostly asked to do. Let's look at requires provided with the pre-adjustment trial balance on 28 February 2018, right? And in the trial balance vehicle, right, is valued at 513,000, and as I've said, vehicles or fixed assets in the trial balance are shown at cost. Then equipment, right, is 235,600. Right, you see this difference here. It shows you that the equipment, the amount that you are given was at the beginning of the year, and the one for vehicles at the end of the year upon take into account any other movements, but for equipment you are given the balance at the beginning of the year. Then accumulated depreciation vehicles is all at the beginning of the year 178,600. Then accumulated depreciation equipment again at the beginning of the year 73,914. Then are given the fixed or tangible note where you need to calculate A, B, C, D, and E. Right, then in the additional statements, the depreciation of vehicles calculated 30% per annum on the diminishing balance method. Take into account that a new vehicle was bought on 1 November 2017. So basically the year is running from 1 March 2017 right to 28 February 2018. The pre-adjustment trial balance reflects an asset disposal of 3,100. This relates to a computer which was sold for 3,100 cash on 31 October. The cost price of the computer was 6,000. The accumulated depreciation up to the date of sale was 3,300. Right, so for this one, they actually calculated accumulated depreciation up to date of sale, so you don't have to calculate current year depreciation when calculating the carrying value at the time of disposal. Right, so it's kind of like a bit straightforward. Right, so working into this, right, calculating our A, right, right, A here is given by, because at the end of the day, what we have is we have this balance at the end. Remember I said the cost, the figures at the top here, right, these are opening balances, and then these ones at the bottom here are closing balances. So we have a closing balance of 513 after taking into account the movement. So the movement, there was an addition of 133,000. For us to get A, basically we need to get how much before we added 133 was. So A will be equal to 500 closing balance at the end minus additions, right? So closing balance 513,000 minus addition, that's 133,000. This will give you, that's 533 minus 513 minus 133, that will be 318. So here you have 318. Then B, of course, it's cost at the beginning minus accumulated depreciation at the beginning, which is 380,000 minus 178,000, then minus 178, that's 202,000. So here we have 202,000. Okay, all right. So then we go to your C, depreciation. Right, for C, for depreciation now, just change it a little bit. For depreciation of C, there are two depreciation that we're going to calculate. and they're using diminishing balance method, right? So you have depreciation on the opening balances, right? Depending on the opening balances, that will be this amount that we got here, right? Or to be simple, the carrying value, right? Because whatever we're going to do is still the carrying value times 30%, because they say they're using 30% per annum. So that would be 202,000 times 30%, because for depreciation, right, calculate depreciation using diminishing balance method, you calculate depreciation on carrying value. So our carrying value is already calculated, there's no need to write it again, right? But if you want to, you can write it that 380,000 minus 178,000 times 30%. So this is 202,000 times 30%. This will give you 60,600. But that's not all. Right, for the new vehicle, that will be 133,000 times 30% times the new vehicle they said was bought on 1 November. Right. It was bought on 1 November and our year is ending on 28 February. So November, that's November, December, January, February, that's 4 months, times 4 over 12. We depreciated pro rata. Right, so that will be 133,000 times 30% times 4 divided by 12. That's 13,300. Right, so total depreciation for vehicles will be 60,600 plus 13,300, right, which gives you 63,900, 73,900, and that will be your total depreciation for vehicles. So that's your C. Right, then we go to D. Right, D, we need to calculate the carrying value that was the vehicle that was sold for. Right, just finish. Then our D here. So when you go to D, right, remember you're given here the asset disposal shows 3,100. That was the cash sale that was sold on 31 October, and they've already calculated depreciation up to date of sale. Right, so if the depreciation is up to date of sale, right, we need to calculate the carrying value on that date of sale, and the cost price, right, was 6,000. So 6,000 minus 3,300 total depreciation up to date of sale. This will give you the carrying value. This will give you D. That's 2,700. So D is 2,700. That's all you need to do. And then the calculation of all the others will have question that will look at how you complete for. Then E. Right, when it comes to E, what you need to do, you need to calculate, the cost at the end, the cost price. So the cost price at the end, basically what you're going to do is no additional vehicles. So what you do is cost at the beginning, this one here, that's 235,600 minus the cost of the vehicle that was sold, of the equipment of the computer, that is 6,000. Right, this gives you 235,600 minus 6,000. This will give you 229,600. So here you have 229,600. So that's how you could basically calculate. Alright, if you like this video, please do subscribe and share with others. Otherwise, thank you so much.